So Glenn and Ben, we were talking about the state of the union and the private equity and private credit markets. Ben, let's start with you. We talked about the importance of value creation in private equity. Talk about an example of an investment where value creation really drove the return.
At Centerbridge, we focus on value investing and transformational investing. So everything we do, we want to have a clear value creation plan. How are we going to improve our businesses? How are we going to make them strategically important, either for an IPO exit or for a sale or monetization to a strategic acquirer? I'll tell you about something we're working on right now. A German business based in Stuttgart, Apcoa, the largest parking lot operator in Europe. Took over the business about 2.5 years ago. It's a high quality sector, great fundamentals, but a sleepy business, underinvested. We came in, we brought in a new CEO, a new CFO, we transformed the board, bringing real estate expertise, digital expertise, and hospitality and leisure expertise. We cut about 15 million euros out of our overhead. We pulled 25% or 20 million out of our working capital. We've reinvested those savings and more back into digital, into technology, and into the sales force. Our new business win rate is now 65%, perhaps zero before, 65%, and our retention rate on that new business is up at 95%. New management, efficient cost, strategic reinvestment into growth led last year the business to deliver record top line, record profits, record margins, and record growth.
Interesting. Glenn, on the panel we talked about the evolution of leveraged finance. Talk a little bit about where you see leveraged finance now and what's changed over the past 5 or 10 years.
Yeah, well again, I've been doing this for 30 years, so again, the perspective is with that kind of context. And in the last 10 years, I won't do the 30-year version today, but in the last 10 years, what you saw back in the first decade of the 2000 period was the largest 5-6 global investment banks doing 80+% of the volume of transactions. Right. And they were very aggressive, they bridged capital, they were the centerpiece between private equity sponsors and debt buyers. In the last 8 years, if you will, or 9 years now, going on 10, I guess, since the global financial crisis, because the banks were pulled back from lending and had to reduce a lot of their balance sheet, some from regulatory, some because of management, and because a lot of capital came into the space from large sovereign wealth funds and pension funds, you had large firms get created or accelerate their growth, where today, we run $32 billion of capital. There's probably 10 of us in alternative credit, 10, 15, who have 20 to 150 billion. Yeah. And when we have that kind of pool of capital, and our others, our friends and peers have that pools of capital, the banks become less important. And so I do think there's more direct origination. And it's not just middle market origination, it's more direct sponsor to providers of capital to work together.
Yeah. So you mentioned large pools of capital right now, in both markets, in equity and debt. A lot of that is dry powder right now. Ben, do you think there's too much dry powder for the opportunity set right now, or how do you think about that balance?
Asset prices are inflated, valuations are high. Everything we do, patience and discipline. About 30% of our pipeline today is proprietary, bilateral relationships, exclusive dealings, and that's the major thrust of our effort today. So we're going into situations where we feel we have deep conviction, long history, a database of financials on a company, and where we feel like we have a proprietary edge, given a relationship, given our expertise, and being exceptionally disciplined and ruthless as to how we spend our time. The auction market today clearly favors the seller. Yeah. Valuations where they are, with intense competition for private equity. So for us, we're looking in Europe for 1 or 2 special transactions every year. And with our sourcing efforts and with our relationships, we have a pipeline to more than fill that opportunity set.
Has the nature of those transactions changed? Are you teaming up more with corporations with the seller, or are you looking for more co-investment opportunity to help you write that equity check? Or how has the nature of deal making changed in this high price environment?
I would say a major theme for us is add-on M&A through the portfolio. Backing our winners, giving them the capital to grow. So a situation where you have a management team you know and trust, you'll have cost synergies. We at Centerbridge will be comfortable with the thesis, and the debt markets are wide open. So our strong performing portfolio companies can borrow at very attractive rates. So we had a situation in the US in vision care, eye insurance. We owned a business, we had a chance to merge with the number 3 player in the sector, triple the size of our platform. We were able to do that entirely with debt capacity. So for no new equity, we now own 70% of a business that's 3 times larger. We told the story to the market. We had our management team on the road. They're performing, they're hitting their numbers. Just 3 months after we closed, we went back to the debt markets, took an incremental $80 million out of the business. So now we own, we think, it's a market-leading platform, 3 times larger than what we originally bought into. Excellent management team. And we own 70% of that for $80 million less than for the first original deal.
Yeah. Ben mentioned debt markets wide open. Do you have enough opportunities for your dry powder?
Yeah, look, it's the same as it is in the equity business, okay? There is a ton of capital in private equity, there's a ton of capital in the debt markets, and by the way, I think there's more coming, because in a world where people are afraid of core fixed income and treasuries going higher in yields and losing money, and equity, public equities having had such a great run, I think more money is coming to alternatives. So the key, just like Ben spoke about, is being selective. And it's identifying companies, industries you like, companies that you feel good about, management teams, which ultimately is what you're backing, and where there are sponsors that you can work with and work well with. And so we have today probably a $20 billion performing credit business, and I certainly would say that the expected return on that is lower today, although actually on the floating rate side, because interest rates have come up, bank debt actually is now yielding 5 to 6%. And then when you take some originated product and you do some targeted complex transactions, you can get 8 to 10 plus. So I actually feel, again, while there are certainly great private equity firms that hope to achieve 15, 20+% returns, the reality is that private equity returns, top quartile's been 11, 12. And if you can generate 8 to 10% returns in the debt market and have downside protection, because it is a hybrid of equity and fixed income, I think that's pretty attractive.
For the businesses you guys are investing in and lending to, at this part of the cycle, regardless of where you think we are in the cycle, are you looking for certain sectors or qualities in the business that make them more resilient to an eventual recession? Are you sort of underwriting with a base case or a bear case of a recession in a few years?
No doubt, and we're constantly having to remind ourselves. We're 9 years into a recovery here. This won't last forever. So we're very focused on downside protection, either through valuation or through structure. We're fortunate with our investors to have very patient capital, long-dated capital. So we spend a lot of our time focusing on what's our downside, how can we avoid losing money or a permanent capital impairment, and if we have a great management team, a clear thesis, and a patient runway, the upside tends to take care of itself.
Yeah, it's not, look, we don't know when the next recession is going to come, and it will come. I personally think that it's going to take longer to get there than maybe conventional wisdom today, but I do think we can go longer. But either way, it's all about picking companies, picking the right securities, getting the right structure. And we certainly feel like investing senior in a capital structure today gives you more downside protection. And again, as private equity multiples get extended, we think very much about what is our loan to value and how do we value that business, not just how did that private equity sponsor value that business. So what I would say, that's certainly key. The second thing, we talked a little bit about this on the panel, is it's not just fear of recession, because I think one of the biggest things we focus on is this whole issue of disruption, and how are businesses getting disrupted, and what's going to change in industry. We talked on the panel about technology impacts. I mean, there's so many industries like retail, which are easy to look at. The entire retail sector is distressed today. The bricks and mortar, most of them are, because of the impact of Amazon. You know, Amazon buys Whole Foods, it changes the supermarket industry.
Right.
So it's, again, it's really being aware of those things that I think is really key.
Yeah. You mentioned retail having some troubles. Obviously, other sectors like energy maybe had their troubles in 2015 and 2016. How are you guys looking at certain sectors right now in terms of more opportunities than others?
Let's go real quick, and that is, we just did one of our largest debt for equity exchanges in our history. We took a 35 to 40% stake in a $1.5 billion oil services company offshore that was under pressure, had been restructured once, then got restructured again, and we took it through bankruptcy, and we cleaned up the entire capital structure. It's essentially nearly all equity today. We're bringing in additional management resources, we're giving them capital, and so I think there's still some things to do there to be, again, an aggressive acquirer of businesses where you can convert things out. That's one of the areas of key focus for us.
Yeah. What about you, Ben?
We're very active in the insurance sector. We recently announced an acquisition in the Lloyd's of London sector. In this expensive environment, we very much like the fact that those risks, reinsurance, catastrophe risk, are uncorrelated to the equity markets, to the debt markets. So within a portfolio construct, we're very excited to be making a strong double-digit return on equity with uncorrelated risk. We've been active in the rescue finance market. Perhaps this is a byproduct of some of the excesses you may have seen in the lending sector. So you've seen us do that with North Sea drilling. You've seen us do that with U.S. healthcare, trying to find winners that will survive some of the changes in the volatility in the U.S. reimbursement environment. So there's a sector focus, but above all else, there's an opportunistic overlay of special situations, of value creation, and trying to find the rare situation where we have a proprietary angle into the company. A management team we've backed in the past. 2 of our deals in the past 12 months have been repeat CEOs. Either buying back into a business where we've had a win, or taking a great manager and going to execute the same playbook again. Because you need conviction, you need courage to go in today's environment, and we're trying to de-risk those investments every step we can.
It's interesting, we've done that with a couple of guys in Spain where we backed them in one deal and have done 2 deals since with them. And again, in terms of other opportunities, I totally agree with Ben. Being opportunistic is key in a market where there's lots of capital.
Right.
And so one area, so you want to find those opportunities where capital is not at. And so I commented on the panel earlier today that in the Spanish home building market, the banks have exited the market,
right,
and there's this dearth of capital, yet there's a need for more supply. So we just created a new platform. We expect to put out $300 to $500 million in new capital, lending and partnering with regional home builders where we think there's some great opportunity. So.
Interesting. Final quick question for the 2 of you. Your outlook for M&A in 2018 versus 2017, more, about the same, or less, and why?
This is one we agree on. Robust. All the indicators, the tax code, cash balances at corporations, private equity, dry powder. I think we'll be approaching a record year for M&A.
So two quotes to use. One is the Trump quote of huge, and the other is, I guess, the old Gloria Gaynor song, more, more, more. I mean, lots of capital available, all the things he just said.
Well, an exciting year ahead. Thanks to the both of you for doing the panel and for this video.
Good, thank you.
Devin, thank you. Glenn, it was a pleasure.